Corsair Gaming stock is down 31% year to date. But look, the PE ratio is sitting at a crispy 16 times forward earnings. Is it time to buy the dip in CRSR? What is going on, investors? Hopefully, guys are having a great day out there. It is time to talk about Corsair Gaming, a stock that is actively pumped here on YouTube. And I won't say I can't confirm or deny, but I think some of these creators are getting a couple dollars to pump this stock up. I'll be completely honest with you. I haven't gotten a single penny to promote this stock. I will be doing this video from just the perspective of an investor. Walk you through the most recent 3-quarter numbers. We'll take a look at a management commentary on some of their product lines and their potential future margins on their products. We'll take a look at how all the devices are selling on a year-over-year period. We'll look at the balance sheet. We'll look at everything that a really strong investor really should do whenever looking at the stock. And then finally, we'll look at this from a technical perspective. I know I got a lot of lines in here, and I'll try to delete some once we get over to this, but it did help me visualize the areas where if you're looking for this stock to bottom and then turn around, these lines should give you some indications. Once you get up and over those lines, it can be a signal that the selling has stopped and the buyers are starting to pile in on this one. Now, we did mention stocks down 31% over the year to date. Over the last year, stocks basically flat. This is supposed to be one of those high-flying pumper stocks, but unfortunately, it just has not been able to meet the expectations over the last year. Now, a $2.2 billion market cap on this one, actually one of the smaller companies that we look at. But I like to look at these companies and look, the revenues came in the most recent quarter at just $391 million. I say just because that's actually down 14% year over year. I tell you what, you're one of these high-flying stocks, momentum type stocks, you start declining revenues on that top line, it's a disaster, especially when you look at all the major FANG stocks grew by at least 16%, and the low end of that was Amazon, which came into some very tough comps. The high end of FANG is growing at 90% if you include Tesla, and at 40% if you count Google. That means this stock is underperforming. There's a reason why this stock chart looks absolutely ugly, and the stock has been essentially dead money, while many other stocks, including mega cap tech, have actually been soaring over the last year. Now, the company did give some guidance on that revenue side to come in between $1.825 billion and $1.925 billion. The consensus was looking at about $1.88 billion. Now, Corsair Gaming is in the business of creating, different, they call them peripherals and other devices that help creators and gamers make products, make content, and do the things that they love. They're basically a consumer electronic company. And what I saw in the financial outlook of the company's press release was a very telling quote. And it says here, quote, "We have responded to the difficult sourcing and shipping environment by building inventory in our hubs closer to our customers. But it has been difficult to pass cost on to our customers." Just absolutely two critical statements there. Now, the first one talking about sourcing and shipping, obviously everybody from the world's largest companies like Apple and Amazon are dealing with this, and certainly smaller public companies like Corsair Gaming are having difficulty with this. And I think for the most part, investors are giving companies like this a pass on this. But it was the second part of this statement, which is just so critically telling, that it has been difficult to pass cost onto its customers. Now, that statement could mean a couple of things. Number one, that the customers just don't have the money to buy the products at the higher cost. There are no more stimulus checks. There are no more free handouts from the government for the most part, unless you have children or you're benefiting from some of these other social, quote, welfare programs that have been handed out since the start of the pandemic. Now, the second thing that could be true is that Corsair products just aren't worth the money. That consumers just, they have the money, they want a product in that category, but it could be that Corsair products just simply suck. And I tell you what, we've got some numbers here in the most recent quarter that actually back up the ladder, that the products just really aren't that good. And we'll take a look at why I am saying that. We've got our 3 months ended here. Our left-hand column is our most recent quarter. This is on a 3-month basis. We see our net revenue went down by that 14% from $457 million down to about $391 million. Now, what also compressed in the most recent quarter quarter was our cost, our shipping, our logistic cost, our sourcing of the materials to make the products have just gone up. And we went from $329, like not down that much, to $289. You would expect this to go down because you had a pretty significant cost of sales decrease. So our gross profit for the most recent quarter went from $127 down to this $101.3 million. Now on to the operating expenses. We have our selling, general, and administrative expenses. This is a complete disaster because you went from $65 million worth of expenses up to $76 million. Remember, I'll remind you that our revenue went down 14%. Our gross profit appears to be down by at least 25%, maybe even more than that. And our SG&A cost actually went up by nearly $11 million. Now, our product development costs, which I don't necessarily expect to ever decline. This is a company that constantly has to be putting out new products. Not only that, be improving the products that they already have out on the market. That went from 12.9 up to about 14.5. Not really a big deal considering, depending on the sales. It's really these SG&A costs actually went up in the most recent quarter. That absolutely obliterated our operating income. Our gross profit went down. Our revenues went down. Our operating expenses went up from $78 million up over $90 million, up nearly $12 million on those cost side. You guessed it, our operating income got blown up. Look at this. We made $49 million. I remember looking at this company a year ago and thinking, man, this is actually a pretty profitable company. I like what I see here. Well, it proved to be just temporary because we went from $49 million all the way down to $10.7 million worth of operating income. Now, they do have to pay some interest on the debt, which I'll show you here in a second. It looks like the banks are as profitable as this company because take a look, they're in the most recent quarter, their interest expense was $7.2 million on operating profits of just $10.75. This is what has investors concerned a little bit because all of a sudden, if these sales drop down a little bit more and the expenses increase just a little bit more, all of a sudden you're paying more on the interest of the debt servicing your company than actually making money. That is a problem. Total other expenses came in at this $8.6 million. That is down because they did refinance this debt, which is good news for this company. They're going to save. They paid down the debt and they saved. So I don't want to kind of gloss over this like it's a complete negative, but I'm just pointing out that this company's operating income has rapidly declined over the last year and that it's putting it in jeopardy in becoming underwater just on its interest expense. We still churned out some net income of $1.7 million. Unfortunately, we're sitting at $36 million in the last year at this time, 43 cents per share, just 2 cents in the most recent quarter. Now, for the last 9 months, paints a slightly different story, but we have to assume as investors, like this quarter is saying a lot, and the management team even said a lot by the fact that they cannot pass these costs down onto their customers. So their customers either don't have money or just simply aren't willing to pay higher prices for these companies' products. That can be a problem going forward. Now, net income in the most recent 9 months still came in strong, $76 million despite the absolute whiff in the most recent quarter. That is up over the previous year of $60 million. So there is still some things to like about what we're seeing, but you have to stretch it back over a longer period of time for Corsair Gaming. Now, here's a better picture of how consumers are demanding their products even less in the most recent quarter. We see gamer and creator peripherals went from 161 in sales down to about $140 million. So we're seeing down there. Gaming components and systems, again, down 295 down to 251. We've got gross profit also trending down in those areas as well, indicating not only are you seeing a decline in prices, but here's our gross margin as well. They went from 37 down to 35, and on the components and systems, you went from 23 down to 21. Our total gross margins went from 28 down to 25.9. Again, that's the combination of increased costs from the supply chain and logistics side and the inability to pass those higher prices down onto consumers for the 9 months paints a slightly better story. And so that's your conundrum as an investor. And this is what great investors do. Half of the market is seeing exactly what I'm seeing. This company is losing ground on top in terms of their operating income. They're earning way less money year over year. Their products appear to not be selling well in the market compared to a year ago. And on top of that, management says they cannot raise their cost onto consumers. Maybe you watching out there understands. Maybe there's a product cycle going on. Maybe consumers just need to take a break after what they've purchased over the last year or two, and they'll resume purchases again in 2022. I would encourage, if you know a lot about this business and this business model, use those to your advantage when you're analyzing a company like this. Now, onto the balance sheet. We've got less cash on the balance sheet. We've got less in receivables. We've got more inventory. I don't necessarily think it's really an inventory problem, because look, compared to the beginning of the year, we have more inventory. And look, it makes sense, okay? You come out of the fourth quarter, holiday selling in December, you should have more inventory. It could be that this company wanted even more than that, but based on the sales, I think they have ample amount of inventory. Now, in terms of our long-term debt, we talked about how they paid that off. We'll see evidence of that on the cash flows. You went from 321 down to 244, and you added about 4.7 million of debt to the current side. All things being considered, they're at that 250 mark on debt, whereas last year they were sitting way closer to 321 million. We'll see evidence of when we come down to the cash flows. Now, the cash flow story is a disaster because we pulled down just this measly $1.7 million worth of net income when this company did $36 million worth of net income. We add back things, get to subtract some things. All things being equal, holy crap, we lost $34 million worth of cash flow just running the business, when the previous year on a quarterly basis, we generated $24 million. That's what had so many people excited about this stock. And you see for the last 9 months, you went down from $100 million in positive cash flow to now just positive $25 million, which was our quarterly run rate. And now we are meeting that just on a 9-month basis. Investors understand if that trend continues, this company will be in absolute deep, deep trouble. We've got repayments of debt. Now, they spent a boatload in the most recent quarter. I mean, they unloaded a clip repaying some debt, but they basically did a refinance. And they talked about this in the press release, that their cost of this debt will go down significantly. So they took on 248, probably a part of that debt, that new agreement, that refinance, they probably had to put some money down on that. They had to repay the debt, take out a lower amount. That's why you went from 373 in total debt and basically added 248. So that is where the net decrease in cash essentially happened. We went from $138 million in cash down to about $76 million in the most recent period. Still plenty of cash on the balance sheet, but when you factor in that this company burned through $34 million worth of negative cash flow in a quarter, yeah, $76 million worth of cash is not really that much. Now, moving on to this stock from a technical perspective, it has been in a downtrend really since March of this year. It peaked out in March, or the stock actually traded sideways from March until about the end of the summertime, June, July time. The stock was right at about $32 per share. It would tick up occasionally to about $34 per share. You must be some kind of news-driven event here, tick this one all the way up to $42 per share. But for the most part, this stock hung out for 4 months this year, right in this $34, $32 per share price. But then once it broke down below it, now we've created lower lows. We're trying to turn things around, but it's still lower lows on this one. That's why if you're trying to buy the dip on this one, you're looking for higher highs now. So you need to come up in here north of $26 per share. That's about $1 higher than where the stock is right now. Wouldn't get too excited about that because there is resistance at $28 per share on this one and $30 per share on this one. And I would expect absolute significant resistance on this stock up at $32 per share. I would expect a lot of these sellers to exit their shares that have basically gone sideways and done nothing for a year if they can come back in here and break even. So I am not liking this from a technical perspective. It still looks like it's on a downtrend. It's showing very little evidence, at least at the current time, that it is trying to reverse that trend. If it does, you're looking for a close on a daily candle, I think all the way up here at about $28 per share. This thing needs to move up about 10% for me to be confident that maybe we're seeing a reversal trend, and we're going to walk our way back up here to $32 per share. That was Corsair Gaming. Interesting company. The financials looked way better the last time I looked at this, and you have a lot of professional money that is looking at the numbers that I'm looking at, and the 32% short interest on this one just shows you there's a lot of people looking at this from a bear case scenario, and that these numbers don't paint a very, very good investment, at least at the current time. And it doesn't look like investors are betting that this company will be able to turn it around in the coming year. That was Corsair Gaming. Hopefully, you guys enjoyed that one. Good luck with your investments.